All right, ladies and gentlemen, we're going to go ahead and get started. Um, as you may or may not know, my name is Terry, one of the co-founders of Innovative Wealth Building, one of the owners and financial planners. I've had the opportunity to do this for almost a decade and a half. And in that time, I've gotten to learn a lot of great things to be able to share with others so that hopefully they can take that information and use it to improve their life and their financial planning so they can live the life of significance they desire and avoid those financial pitfalls that are easily avoidable. Before I jump in for about 45 minutes of content, could we do a sound check? Could someone just let me know in the chat box if you can hear me and if the sound is okay? And then we're going to go ahead and get started. Perfect. All right. Thank you. Thank you. So, yeah, we'll go ahead and jump in. Thank you. Thank you. Always the same disclaimer. The things we'll talk about today are going to be financial education. While IWB is licensed to speak and give financial advice across the country, we do not represent this to be financial advice or recommendations, purely education and general information. For concerns relative to your specific situation, we would definitely say talk to your financial advisor or someone who has enough information about your situation to give you the correct answer for you and your family individually. While I will talk a little bit about taxes, estate planning, and other things, important to know that I am not a chartered public accountant, nor am I an estate planner. However, given my background of CFP, Masters in Financial Planning, and things of that nature, I do have the authority to be able to comment and share information on a bunch of these different nuanced topics. So, without any further ado, we'll jump right in. As always, if you have any questions, please put them in the chat box. I will continue to take a look at the chat box throughout today's conversation, and I'm happy to talk to you. So if you have questions, comments, concerns, just let me know, and then I'll take a pause, and then we'll just talk about what you want to talk about. The agenda for today is all about planning for life events. There are so many big life events that can throw us financial curveballs, in addition to just the lifestyle changes that may come with them. We're going to focus on some of the basic ones today. We'll talk about marriage, about new baby, maybe that's a child, maybe that's a grandchild. We'll talk about divorce, loss of life, just the unfortunate things that can happen in a life well lived, and also some of the good things, such as marriage and a new baby, that can cause us to change our planning a little bit. Of course, this will be about the financial context, but as we all know, any of these big decisions changes more than just our finances. It changes our environment, our family, our mental health. There's just so many things that change throughout life. So whenever you're in a big transition, make sure you're leaning on the professionals and the people close to you to ensure that you have the support you need to get to the next phase. We're going to start with marriage. And for some of us on the call, I've been married for, let me do the math, 8 years. Some on the call have maybe been married longer than that. But let's take it back for those that are maybe newly married or not married yet. One of the first things that I would say is you do want to have the money conversation. Throughout history, money has sometimes been a taboo topic. We don't want to talk about it. You know, there's that list of things we don't bring up at Thanksgiving dinner, and money has always been one of those things. However, divorce is a real thing. And in most divorces, financial struggles or challenges are something that come up quite often. Now, I'm first saying that the money conversation is important when you start off in a relationship, but maybe you've gone 10, 20, 30, or 40 years and you haven't quite gotten aligned with your partner on the money conversation. So for some people, they need to have the conversation. For others, they need to circle back to the conversation. Retirement is a huge opportunity to circle back to the money conversation. I've seen folks married for 40 years retire and they have completely different ideas about retirement, how they want to spend their money, how they want to give their money, and it leads to conflict because they're both making that transition from being savers to spenders. But if there's no alignment, then that can lead to some friction and some unnecessary problems. So I would just say have the money conversation with a spouse, with a sibling, with people you care about. By being able to proactively have that conversation, you can make better decisions now and also pave what I would call the yellow brick road to financial success going forward. As you have this money conversation, you do want to consider the structure of your assets. The most simple way to hold assets is a single individual account in just one person's name. But if we're talking about multiple people, there's tenants in common, there's joint with rights of survivorship, there's all these other ways that you can title money to meet your needs. Be considerate of tax consequences and estate planning consequences to adding people to accounts, taking people off of accounts. It all matters. So as you're doing these things, talk with qualified professionals to ensure that good intent doesn't accidentally lead to something that could hurt you financially. Number three, I would say, is to align with shared goals. Often in school, you'll see that 1 + 1 = 2. But what I've found is in the context of finance, when two spouses or two folks are on the same page and they're aligned, 1 + 1 doesn't equal 2, it might equal 10 because it's the synergistic effect of two people working in lockstep towards a common goal. So I would say alignment is probably one of the unsung heroes of happy financial planning. And that starts with conversation, that starts with compromise, mutual education and learning and listening. But having that shared vision could be phenomenal. That could be around buying a home, investing in real estate, how many trips to take in retirement, if we're paying for the kids or the grandkids. It's all those things. Buying new cars. Do we want to get a boat? Should we really buy that hot tub? You never get in it. All those money conversations can come down to just alignment and setting good expectations. Lastly, when you get married or when you're revisiting your documents, there's probably some updates needed. I've seen times where one spouse isn't listed on a document, or an old 401(k) plan has a person's parents on it instead of their spouse and kids. So over time, you just want to make sure you revisit your documents to ensure that they are up to date because we never know when our last day is going to be. So we want to be prepared today so that if we live forever or if something happens tomorrow, that our affairs are in the best order that we can leave them. Let's talk quickly about some common pitfalls. One pitfall to avoid is just bringing yourself together with someone else and just ignoring their financial situation. I've seen this happen. I know someone, they're getting married soon, and one of them's pretty good with money, and the other has a 500 credit score. And they're going to come into this union and bring everything together. And if they don't make some progress and make some commitments, this could lead to some bumpiness along the road. So being transparent, being open, and just working together to figure out where we are and how do we get to the ultimate goal together. Having a budget can be incredibly important. Most people don't have a written budget. Those that do often don't follow the budget. And I get it. Budgeting is not the most fun thing in the world. If you don't want a budget, then all you have to do is pay yourself first. Set a percentage you want to put to your future, and then spend the rest. And if you put enough to your future, you truly don't need a budget, and you're probably going to be fine. So when you're young in your early 20s, if you're putting away 15 to 20% of your income, you're going to be just fine as long as that money's growing somewhere. If you start saving later in life, your savings rate may need to be a little bit higher, but it all depends. Are you going to retire at 75 or 55? Do you want to spend 10,000 a month or 4,000 a month? All these things play a role in budgeting and setting the right number for a savings percentage. Lastly, I would just mention taxes. I have people come into my office the last quarter of the year and they'll say, Terry, should we get married for tax purposes? Probably not. There are times where I guess it could be helpful, but it leads to surprises. You know, the way that the joint tax code works is we take all of your stuff, we take all of your stuff, we put it together, and we kind of split it down the middle. That's married filing joint. Now, you can file married and separate, but there are some drawbacks to married and separate, especially in retirement. So, rushing to get married just because it's the end of the year and you want to save money in taxes, maybe not the right decision. However, in some situations, it could save you a bunch of money. In other situations, you could end up getting are owing taxes when you thought you were going to get a refund. And that may not be a happy conversation. So 12/31 of the year, that will dictate how you file your taxes. So you can get married on New Year's Eve. Just know that it doesn't always do the trick. It is not always the best decision to make. Where is the best? So I'm just going to go to a quick question. Where is the best place to put your money when paying yourself first? Yeah, great question. The first place I would say is a bank account. When you're paying yourself first, you want to have an emergency fund. Because if you don't have an emergency fund, then you're going to have to maybe take on debt to cover short-term things. In addition to your emergency fund, that 401k, that individual retirement account, something for your future is another good place to put your money. Third, I would say, if you're paying yourself first, is a taxable investment account. Savings accounts are for day-to-day expenses. Retirement accounts are for when you're 60 years or older, generally. That taxable investment account, it's for money you spend tomorrow or money you spend in 10 years or 100 years. If you use those three types of accounts, you're pretty much bulletproof. Those three accounts can solve most of the financial hurdles that you'll ever want to overcome. So, great question. The order of precedence is often emergency fund, retirement, and then funding that taxable investment account, which is like your interim account. But any combination of those three can be awesome. So, again, a taxable investment account, I've heard it referred to as a glorified savings account. It's flexible like a savings account where you can put money in, take it out anytime. But instead of it just being invested at the bank, you can invest it in stocks, mutual funds, ETFs, bonds, whatever you want. So, real life example, I have a taxable investment account that I've been feeding ever since I started being a financial advisor at age 20. That account has grown to a decent size. We're doing a renovation on our new house, and instead of taking money from the bank, I pulled a loan from my taxable investment account. I paid the contractors, and I can pay myself back whenever I want. My taxable investment account, which again, it's almost like a bank account, but it's invested in stocks and bonds and mutual funds. Let's say it's growing by 10% a year and my interest rate is only 6%. I'm borrowing money, but I'm still making money. I'm not actually losing anything. So that math gets a little squirrely when the stock market goes down. But that taxable investment account, it's like a Swiss Army knife for saving money. And honestly, it's an underutilized account that most people don't have. So it's also referred to as a brokerage account, a non-qualified account. Some call it a stock account, but it's basically just an investment account that's not tied to retirement. So it's not an IRA, it's not a Roth IRA, it's not a KEO, it's not a 401k 457. It's just a vanilla investment account. There's another question or statement. I put money into my wife's IRA, fund our joint IWB account, and I fund my taxable account that I manage. Yeah, that's awesome. Truly, the IRA or retirement account, the taxable investment account, and the bank account, those are three of the most important accounts out there. There are other ones, such as 529s for education and health savings accounts, but just those big three probably covers 90% or more of the assets that people do build up over time. Great questions, great comments. Keep them coming. Let's talk about being a parent. When I first became a parent, I was in a situation where I did not have more money than I knew what to do with. Truly, when the baby was on the way, I said, how are we going to afford this? Because there's some startup cost. Our son probably was a $10,000 to $20,000 baby. Both of our kids, one of our kids got to ride in an ambulance the first day he was born. That was not fun. We got to spend 7 days in the intensive care unit with him. That was not fun. So the first thing I would say is make sure you have health insurance. If we didn't have health insurance, we probably would have got hit with medical bills, 6 figures or above, just to have our two kids. So that's the first thing. Make sure you have health insurance. Also, understand how your plan works. Back when we had our first child, the way that the plan worked was when he was born and added to my wife's plan, it started a new deductible. So basically, all the first $5,000 was on us out of pocket versus him being able to borrow the deductible we were already paying towards. So there's little nuances where if you do some planning and look into your benefits, and you know a baby's on the way, I would pick the plan that's going to save you the most money. In addition to just having a child, you're going to have to look back at your budget because maybe one or both parents are going to work less. Maybe you need some extra assistance, be that daycare, a nanny, sliding mom a couple $100 for helping out. Babies need stuff, diapers and milk and, all sorts of things. So your budget is usually going to have to absorb some extra expenses. There are some studies out there that will say the first year cost of a new baby is an extra $12,000 to $15,000 for the first year. I'm going to throw that to the audience. Does everybody agree that the first year having a baby costs you less than $15,000 in new expenses? I'm just curious. I don't think that number is a good number, at least not in my life. Because depending on where you live, I mean, childcare could be the same as your mortgage. So we had some real big eye-opening situations living in Washington, D.C. and having children. We thought, man, how do people afford this? And the answer is you have to maneuver and sometimes make some adjustments. So 12 to 15,000, that was a number we found doing some research, but you may need to think of a bigger number for the annual cost of bringing a child into your household. Lots of factors. Let's keep rolling. Often, when you have new responsibilities, you may want to consider more life insurance. When we had our first child, I increased my life insurance. Why? Because if I got hit by a bus and my income disappeared, my wife and my child would be worse off. So I bought more life insurance. We had a second child, I got more life insurance because now there's two college educations to pay for. I've got two boys, they eat a lot. That's more grocery bills. So that's just something that I did. Not to say you have to increase your insurance every time you have a child, but for me, it just kind of made sense. Another financial, I don't want to say liability, but truly it's a financial commitment that you're making for an indeterminate amount of years in the future. So just reviewing your life insurance and considering if you need more or want more could be a good thing. Education planning. I mentioned earlier the 529 is one of the best education vehicles out there. Some states, such as Maryland, does give you state tax deductions to put money into your 529. Other states, like California, they don't care. You can do the 529, but you're not going to deduct any money in the state of California. So net, the 529 is the best education fund there is. You put money in, you can sometimes take a state tax deduction. That money grows tax deferred. And if it's used for qualified educational expenses, which is a super broad thing nowadays, you get to spend the money tax free. So you put in, let's just say 10,000, it grows to 40,000, you spend it tax free. That's an amazing thing to do. One of the cool things about a 529 is you can open one before your child or grandchild's even born. Terry can open a 529 right now, start feeding it $200 a month, and in 30 years when I'm a grandparent, I could change the beneficiary from myself to my grandchild, and boom, 1 year old, and they have a $100,000 529 account that will continue to compound tax deferred and get spent tax free. I could have just paid for $1 million college education by just starting early. Now, will college cost $1 million someday? Maybe. Some colleges are $250,000 or more today in 2026. Will we not go to college in the future because everyone's going to have a chat bot in their wrist? I don't know. We'll see what happens. But the good thing about 529s is if you put the money in, you can take the money out. Yeah, there's some taxes and penalties, but hey, I'd rather get the money back and pay a little bit of the tax that I owe anyways and the penalty versus not getting my money back at all. So again, for education, 529s are the best tool out there. There are some limitations, but net, it's probably the best tool without very much argument. Last thing for new parents is to update your estate plan. For most parents, to be real, you just need to create an estate plan. Many people, if they were to pass away, would die intestate, meaning they have no will, meaning the state gets to decide what happens to their assets and gets to decide what happens to their child. One of the most important things is to establish who would be guardian of your child in the event that you pass away prematurely. You don't want the state figuring it out. You don't want the family fighting. You don't want your child ending up with a random lawyer in the neighborhood. You want to pick who's going to be entrusted with your child's physical safety, it's a hard thing to decide, but it's an important thing to decide nonetheless. I know my wife and I went around and around and around and around working on that one, but we ultimately had to make a decision because we didn't want the state to decide for us. So we had to make that decision. Divorce and finance. Um, Divorce it's a tough thing and it does happen. We've probably all seen the statistics that it happens relatively often. And for both people, it often leads to tough times financially. There are some startup costs, there's some cost to distribute things, there's legal fees, there's lawyers' costs, there's court cost. It's really like a reset, and it's often a step backwards financially for someone or for both people. So I would say that just generally speaking, a divorce is a setback that we need to plan how to come back from. And it's tough. I've seen people through a divorce process, someone acquires a house, but it's a house they can't really afford, especially if they have to refinance it and take a higher interest rate and their income's not that high. So there's all sorts of things that happen that are pretty difficult. Important thing is just to keep good records and documents, understand how assets are divided based off of living in a common law state, community property state, and then just be realistic about your cash flow. If you're in the situation where you think a divorce is possible, maybe not a bad time to take a pen and paper and kind of sketch that out to see what that looks like. There's child support, there's alimony, there's splitting expenses, there's deciding who gets to claim the child and take the tax credit on their tax return. There's all sorts of things you have to kind of sift through. Suffice to say, financially, it's a step back. Um, Personally, probably a painful thing and a step back. And it's an important thing to figure out how to come back from. You can come back from it. I've seen people recover from divorces and do phenomenally well. But, you know, in rare cases have I seen someone just take off because they're like, yep, I won. Things are so much better. It's amazing. That could happen. Someone could come into a windfall. But if you've never been entrusted and had to make decisions with lots of money and then you're in the driver's seat, that could also be a tough thing. So I would just say take it seriously and just make sure that you do the best you can, or advise or help others go into that situation and do the best that they can. We'll talk now about survivorship. Now, I'll just say this is a very, very, very like rough thing. It's saying that there's a time frame in which you should do certain steps. My personal experience is that everyone goes through the grieving process at their own pace. So there's no speed of which you should go through things. I've had widows, they're getting harassed by Social Security because Social Security wants them to fill out paperwork to get money that is due to them. And they're like, you know what? I'm just grieving. I don't want to answer the phone. I don't want to fill out the paperwork right now. And I understand because, if you lose someone that you have planned for 40 years to do fun things with for the next 30 years, that can be really tough. And there's a big transition there. So losing a spouse, be that early in life or late in life, I would say it's equally traumatic, for not only the spouse, but all sorts of other folks, the kids, the grandkids, the in-laws, the parents, the siblings. So as you work through that process, identifying and locating the documents is going to be really important. I've seen bad situations where there wasn't good communication or there wasn't good records kept, and then someone's searching for stuff. We're pulling bank records to try to find companies like Prudential to then call Prudential and see if we can figure out if there's a life insurance policy there. We're hunting down Vanguard and Fidelity and all these people because we just don't have the data. So, one of the best things that you can have in place for yourself to leave to the next generation or your spouse is a balance sheet. And a balance sheet is just a list of your assets and your liabilities. The assets are probably the most important thing. The house, the car, the jewelry, the stack of gold under the grill in the backyard, the retirement accounts, the investment accounts, the life insurance policies. You got to have somewhere where those things live. I know that we have a system called Asset Map that many of you may have, where if someone has your asset map, that's your balance sheet. They know where your things are. Or if they have your financial plan, they can see an itemized list of different accounts and know where those accounts are located. So identifying those things, contacting Social Security, contacting the federal government, if it's a federal employee or a military person, those things are going to be super important. You're also going to want to meet with your lawyer, your accountant, your financial advisor, whoever's needed to help update things, make these transactional moves, get death certificates. There's going to be changes needed for beneficiaries, retitling of trust. There's just a bunch of administrative legwork. And again, no one wants to dive into this stuff head first when they're going through survivorship. But if you can, you do want to try to get it done at a reasonable time frame because the worst case scenario is your person you love passes away and then you pass away. And now there's a double issue for the people inheriting because the beneficiary of something passed without taking the item into their own name. And then it's just extra paperwork and extra hassle. So it's a tough thing to do, but you do want to try to get to it when you can. Ultimately, when you get through the administrative process, you just want to reset, get a fresh look at your goals, where you are financially, if things are working or not working, and then just get the right plan that's going to carry you from now through forever. Who knows how long forever is, but we just want to make sure that whatever comforts you enjoy today can last for days, weeks, months, years, decades, etc. So, um, one other comment, we do sometimes run what's called a gap analysis or a life insurance analysis. There's research out there that says most Americans don't have enough life insurance, and they know that, but they just don't have it. So if you've never done a gap analysis and you're curious, that's something we can easily help with. I run that for myself. The way it basically goes is Terry gets hit by the fruit truck, he's gone, and then we set the goals for Kenna and the boys, and then we put it into this computer and it does all the math and it says, boom, to solidify your family standing today, you need X million dollars of life insurance. And if I don't like the number, I can change the goals, I can change the interest rates, I can change the tax rates. But ultimately, it comes down to you. You get to author your own survivorship plan and make it so that you're remembered the way that you want to be remembered. And that doesn't have to be expensive, but it should be planful. So I would say if you haven't done a survivorship analysis, and that could just be for survivorship for your spouse, that could be for generational wealth transfer. There's all sorts of good reasons to do the math. Your advisor has the tools. So if that's of interest, let your advisor know, and that's something that's easily doable. I've mentioned many of these critical updates already. Beneficiaries need to be updated, estate documents. If someone passes away who was a trustee or they were the beneficiary to your accounts, you've got to update those. Maybe they were your appointee if you were unresponsive after a car accident. Well, that's an important person that you have to update now in your estate documents. So insurance accounts, account ownerships, again, these are just all the administrative things that you kind of have to go through. So if you're ever in this situation, this is something that unfortunately we help people with all the time because clients pass away. So we have checklists to kind of go through and help you update all these different things. Looking at the question, what is your take on revocable trust? I think revocable trusts are awesome. I don't know why I'm smiling. I do truly think they're awesome. So if we just don't think about the cost and we do a trust-based estate plan versus a will-based estate plan, the trust is better, hands down. The will-based plan goes through probate. Probate can be long, it's public, and it has cost and fees. A trust is private. It doesn't go to probate, so it goes around probate. It does have a cost, but effectively with the trust, you pay for the cost up front versus having all the probated costs on the back end. And generally, the cost for a trust is less than what you're going to pay through the probate process. So I do really like having revocable trust. Number one, because it's private. I don't want everyone being able to look up my name at the local, county repository of wills and say, oh, Terry left behind X, Y, and Z. That's not really their business. So I do enjoy the benefits of a revocable trust. And then also just the ability to set parameters and guardrails. My kids are young. If my wife and I die in a common accident and they're 5 and 3 years old, my trust can state exactly when they can use the money, how they can use the money, when it's going to be in their full control, who's in charge. There's so many different levers you can pull to help keep people from hurting themselves financially and to just do your best to design a future where they're going to financially be okay without you. So that was a super long answer. I do like revocable trust. Again, net, they're better than a will-based plan. The only downside is they cost more to set up and then they cost more to revise. However, there are some legal people that will do it at a decent rate. Another question. What tool did you say you use to manage your assets? I might have been referring to Asset Map. So that's a tool that we have where we can put all of your financial assets onto one sheet of paper. And then we can also run target maps, retirement analysis, life insurance analysis, long-term care analysis, college funding analysis, etc. We have other financial planning tools called eMoney and Right Capital. We have a bunch of tools. So those are typically the tools that I use for running those types of analysis. Even on tax and estate planning, we have additional tools for advanced planning. But I think Asset Map is one of the most basic ones that's really good, where all of your items are on one sheet of paper. Even your Social Security, even your federal pension, whatever you have, we can put it all onto one beautiful sheet of paper. And it's a great conversation piece. So please let me know if I need to elaborate any more on that. Do you have to continue to feed a trust? Short answer is I would say no. You don't have to feed a trust. Once the trust is established, it's in force. You can use the trust as a vehicle to receive proceeds. So your investment account, for example, you can either title it in the trust or you can have it pour over into the trust by way of TOD, transfer on death. But no, you don't have to continue to feed the trust during your life. There are several ways to do the trust. The one thing that I would just say is some people do what's called a pour over will. When I die, take all of my stuff, lump it together, drop it into my trust. That works, but that goes through probate. That's the only problem. So probate can have its own delays. I like to avoid probate where we can. Having a pour over will, though, is a heck of a lot better than having just having no will or having one that misses a bunch of items and doesn't state what to do with them. So, because again, if you don't give the instructions, the state gets to decide. We call that the default plan. The default plan is usually not good. The default plan is typically pepperoni pizza or a cheeseburger. Maybe you like it, maybe you don't. So we try to customize wherever we can. All right, great questions. Let's talk again about life transitions and just some of the tax implications. I mentioned marriage earlier. Generally speaking, if you're claiming single versus joint, roughly for married and joint, it's just double. So if the tax brackets are 20% at 100,000, it's just 20% at 200,000. If the standard deduction is 10,000 for single, then it's doubled for married. There are some areas where married people do get a bit of a break. Like there is a bit of an advantage in some ways. But there's not just single, there's head of household, there's qualifying widower, there's other statuses. Also, if you're married filing separate, there are some penalties. So certain things are not good related to Medicare and some other things in retirement if you don't claim married and joint. So just be aware of how those tax ramifications happen. There are some special considerations for business owners, probably beyond the scope of today's conversation. But again, taxes are the biggest expense some of us will ever pay. I like to measure twice, cut once when it comes to tax strategy. For new children, there are deductions, there's credits, but it's all based on your income. Quick example, let's say that a couple makes $500,000 a year and they have 5 kids. They're getting 0 tax credits for those kids. So that's like $10,000 plus they're going to pay in taxes just because they make too much money. If they made less money, they would have got the tax credits. I've seen situations where parents or grandparents become the the guardians for children and they take the credits on their return. There's all sorts of ways things happen. But again, just know with children, it gives you abilities to fund flexible spending accounts, take deductions or credits. There can be credits sometimes or deductions for childcare expenses, earned income tax credit. You have to have a child living in the household. So again, there can be lots of financial incentives with children, also related to adoption and other things too. We talked about divorce and said that there are many ramifications there. Sometimes people are having to pass assets back and forth, and there are some tax things related to that. So, of course, if you're working with a lawyer, they're going to help you do that the right way. And then survivorship. One of the interesting things about survivorship, if you're married and joint in retirement, let's say your income is here and you have joint tax brackets. But one person passes away, your income decreases some because you lose one of the social securities, but then your tax bracket also gets cut in half once you're no longer a qualifying widow or widower. So we sometimes call this the tax torpedo. Depending on the situation, when you go from joint tax brackets to single tax brackets, you may end up paying double or triple for Medicare because you now are above certain thresholds that you weren't above previously. So it gets really interesting. The rules do not always work in the favor of a widow or widower. And then additionally, if you have inherited IRAs, you have 10 years or less to take the money, depending on the relationship, there's all sorts of crazy things. Again, there's too many tax laws for us to cover in today's conversation. I would just say, if you've never talked to your advisor about tax efficient ways to leave your assets, maybe that's a topic for consideration. I have a client who has a big, big, big portfolio of Apple stock. Their basis is basically zero. So if they were to take all of their Apple stock out, they would pay taxes on all of it. Let's just say it's $2 million. What they didn't know is if they die and leave that $2 million to their kids inherit the $2 million and pay $0 in taxes. Something that simple can be part of your strategy of which assets you spend down and live off of and which assets you leave behind for tax-free wealth transfer. So there's too many things out there for any one person to track. So if you haven't had a conversation about wealth transfer or prioritizing assets to spend down or the tax ramifications, again, could be a good thing to bring up and just to do a little bit more conversation and planning on. So I think this is one of my last couple slides. Practical preparation steps. I'll just recap. For marriage, I'd say step one is to become more financially sound personally. That could just be education, learning about financial strategies and financial empowerment, taking baby steps and small steps to build yourself so that when you come into a relationship with someone else, regardless of where they are, you're already on good ground. So you can help them develop good ground and then rise together. So I would say just being proactive on your personal development as a single person will help you become a productive married person financially. For children, start early, pick the right health insurance, start saving early for college. Maybe pass up on a couple of those opportunities that you have and just sock away some extra money. I can almost guarantee you that if you sock away a little extra money, even 5 or 10 or 20 years before having kids, you're not going to be upset that you did that. It's going to give you more choice and flexibility and less stress. Lots of things in my life could have been way more stressful. I started saving at 20 years old because I was an intern as a financial advisor and I started with $50 a month. So that by the time anything pretty much happened in my life, I didn't have to stress. On a whim, I quit my job. I moved across the country. I got married. I didn't make a dollar for 6 months and things were just fine. That would have never happened if I hadn't started saving super early. And I'd say the same thing is true with having children. If you start putting away a little extra money now, probably going to be a good thing, especially in that taxable investment account. You don't want to put it all into retirement because that money is a little harder to touch, but that taxable investment account can be a great place to put some of that extra money. Divorce and survivorship, big challenges to overcome. I think we talked about those in pretty good detail. Again, for survivorship, I would say the big thing is just while you're living, decide how you want to be remembered, decide how you want to take care of your family, do the analysis if you have to, consider the different tools out there, and then just put what you want in place and then live life to the fullest. I will make a comment. And Barjo, I'm going to keep your name anonymous. Um, we learned this together. So let's say someone's receiving Social Security and they pass away. Sometimes Social Security won't pay them the last paycheck that they're supposed to. That's because Social Security runs a month in arrears. So let's say Terry starts his Social Security in the month of January. I don't get any payment from Social Security in January. My first payment is someday in February based off of the day that I was born. What sometimes happens with Social Security is a person passes away, let's say February 1st. Social Security gets notified and they don't make the payment to them on February 20th. Well, the thing is that February 20th payment was actually the money from January anyways. So there's actually a form that you have to fill out and submit to Social Security to get the money paid on behalf of the decedent that should have been paid anyways. Barjo sent this to me and told me to make sure that I tell people. And I wasn't thinking about it until just now. I believe it is the form SSA 1724. So SSA 1724, claim for amounts due in the case of deceased beneficiary. The big thing to remember, if someone passes away, there's a chance their last Social Security check was not paid to them. So you have to fill out the paperwork and file it on their behalf. Could be $2,000, could be $4,000, but it's money that is supposed to go to the beneficiary. And otherwise, Social Security Administration may not pay it out and it may just disappear into the ether forever. So, Barjo, thank you again for sharing that with me via email. And sometimes we go through things personally so we can share it with others, and that's going to save somebody the headache, but also just knowing that that money exists and that they can get a hold of it. So as we get ready to close up, overall, your financial plan should evolve with your life. As these transitions and life changes happen, your priorities are going to change. The things that are important or not important are going to change. So we have to reassess and be nimble and pivot sometimes to align our actions, our money, and our time with the things that matter most. At those different stops, I would encourage you to just assess your current situation, to revise and update your goals as needed, to think through, project, and implement changes that are going to keep you on the glide path to success, and then to monitor your success or just to monitor your progress and to give your advisor permission to walk that walk with you to help hold you accountable, to help give you guidance, to answer questions as you continue that pursuit of financial independence. Sounds simple enough, right? Assess your situation, update, implement, and monitor. But when life is busy, things get kicked down the road. So that's why we like to have our ongoing meetings to check in on progress and then to help give a little bit of extra encouragement and forward momentum if and when we need to. Whew. So that is the end of my formal comments for today. One of my team members put in this little slide for me. I'm going to check to see if it works. So it does work. Many of you are our existing clients. If you've had a good experience or any experience that you want to share with someone else, and just to help us with gathering more feedback on our website, feel free if you'd like to scan the QR code and just leave a comment about any results or any just experience you've had with our team in innovative wealth building. Doesn't necessarily need to be about the presentation. You don't have to stoke my ego and say the presentations are really good, although I don't hate it. But if you've had some experience over the years and you want to share the impact your advisor has had working with you, that would be helpful to maybe some others who don't know us yet that maybe could benefit from the opportunity to sit down and have a conversation with us about their finances and how we may be able to provide support. So that was thrown into the slide. They made it nice and big so I couldn't miss it because I usually don't think about it. So that's a quick little QR code to our Google page. So that's it. Those are my formal comments for today. I'm not going to lie, I'm impressed. We finished 10 minutes early and we started 5 minutes late as always. So I think that's a win. I'll look at the chat box. Any questions, comments before we close up today? There are some questions. So let me go to the questions. On your slide, you show term life insurance. What about whole life insurance? Um, Barjo, happy to share it. Great question, Kathy. Permanent life insurance, which is whole life, universal, and then some other types, and temporary or term are both incredibly important. I didn't mean to gloss over that. Term is important to have the right quantity of coverage. Permanent is having a higher quality of coverage because it can last forever, which is age 121. It has cash value, it has all these other benefits, long-term care. So yes, having both of those coverages can be awesome. So if I glossed over that, apologies, but we do recommend having a complete risk management portfolio, which often has both temporary and permanent life insurance. So thank you for pointing that out. Trump accounts. Ricky, you are reading ahead. I think this is coming in our newsletter. What can be used for and who should use them? Um, you know, they're still not fully baked. I won't make too many comments on the Trump accounts. Essentially, they're supposed to be accounts for children that could be helpful for college and other things. I think of them as almost a bridge between a 529 and then maybe an older account called an UTMA, a Uniform Transfer to Minor account, which isn't used that much anymore. It's still being baked, so all the rules aren't there yet. But essentially, it should be a type of investment account where you can put money away for a child for future usage that hopefully will have some tax benefits. Some of the growth being taxed at the child's bracket instead of the parent's bracket. But again, it's still not fully baked, so I won't go too deep on it. But we do have some comments coming up in the newsletter. And when it's fully written into law, we will put out more information specifically about all the ins and outs of how the accounts will work. So thanks for asking that. Julia, do we have a calendar of your future presentations? That's a good question. I know that we put together a big content calendar for the year. This year, we're going to actually do these presentations plus workshops online, plus in-person workshops as well. So I don't think we have the full thing published yet. I'll make a note of that for us to circle back. And once we have the full calendar, we can put it out. If you want to send a note, the best place to send it is your team at teamiwb.com. That's monitored by our office manager and the queen bee, Anne Marie. I guess that rhymed. She would be someone who would know when that will be developed and available, but we do want to get that out there so you can see far in advance when all the topics are, and then where we're going to have the workshops, the webinars, the in-person stuff, maybe sprinkle in some little special things. So yes, thank you for that question. I will circle back and see if we can get an update on when that full schedule for 2026 will be created. But generally, we have webinars. I believe I'm just looking at my calendar. It's the the third Wednesday of every month. So any month, the third Wednesday is generally when these are, but I'll see if we can get a full schedule put out there. And Ricky says, where can we view the prior webinars? Yes, it's on YouTube. So we have a YouTube channel. If you want the YouTube, again, the easiest way is just shoot an email to your team at teamiwb.com. I guess that would be helpful if I wrote the whole thing correctly. Your team at teamiwb.com. If you shoot a message and just say, hey, can you send me the YouTube link? Then you'll be able to find us. We do have it. I think if you just were to go to YouTube and type Innovative Wealth Building, you'll find it. But we're happy to actually send you the direct link. Every webinar should be hung on there. Any other questions? All right, well, I'll keep an eye on the chat box to see if there's any further questions. As always, I like to end these things by saying thank you. Appreciate you taking the time to tune in, spend an hour with us to talk and learn about financial concepts. I hope you found today's presentation to be valuable. And this conversation and many of the other ones this year are based off of the information that you all sent us. So we sent out surveys and you told us what you want to hear about. So you're going to get a lot more of that during 2026. So my pleasure to be here with you. Thank you so much. Have a great rest of the night, and we'll talk to you next time.